Welcome to Biocon Group's performance overview for the second quarter of FY26. Business performance this quarter has been strong, with operating revenue up 20% year on year to rupees 4,296 crores. This has been largely driven by robust growth in biosimilars and improved momentum in generics and a steady contribution from the CRDMO segment. EBITDA grew 29% to 928 crores, while profit before tax, excluding exceptional items, surged 153% to rupees 183 crores. Now, before I get into business segment updates, let me share some key highlights for this quarter. The first and most important announcement I want to make is that we have strengthened our balance sheet by settling structured debt obligations that we had with Goldman Sachs and Kotak from the QIP proceeds and by executing an agreement with Edelweiss. We have already started to see margin improvement in Q2 following the Goldman Sachs exit, and we expect this trend to continue through Q3 and Q4 as we will benefit from the impact of the Kotak and later Edelweiss exits. The full benefit of debt reduction will be visible from FY27 with annual savings of around 300 crores in terms of interest costs. Let me now comment a bit on our sustainability and ESG improvements. On the sustainability front, the Biocon Group recorded notable improvements in its ESG scores, which reaffirms our commitment to responsible and sustainable growth. Biocon recorded 71 in the 2025 S&P Global Corporate Sustainability Assessment, reflecting an improvement of 3 points over last fiscal. Syngene saw its EcoVadis 2025 score rising to 74 from 66 last year. This places the company in the 91st percentile, ranking it among the top companies worldwide for sustainability practices. On the corporate governance front, I am delighted to say that Biocon Biologics won the prestigious Golden Peacock Award for Excellence in Corporate Governance for the year 2025, which was conferred by the Institute of Directors in London very recently. Now, let me walk you through the financial highlights. In Q2, at a consolidated level, operating revenue stood at 4,296 crores, which is up 20% year on year. Biosimilars reported 25% year on year growth. Generics reported 24% year on year growth. And the CRDMO business reported a modest 2% year on year growth. Core EBITDA was 1,218 crores, which is up 23% year on year with a margin of 28%. R&D investment, excluding Syngene, was at 251 crores or 7% of revenues. This, of course, reflects continued pipeline investments across both generics and biosimilars. EBITDA grew 29% year on year to 928 crores with a margin of 21%. Profit before tax, excluding exceptionals, rose 153% year on year to 183 crores. And net profit for the quarter was 92 crores. And after adjusting for exceptional items, net of tax and minority interest, the reported net profit stood at 85 crores. Now, Moving to business segment review, let me start with biosimilars. Biosimilars delivered a revenue of 2,721 crores this quarter, representing a 25% year-on-year increase, driven by robust demand for our products across key geographies. This growth in revenue translated into an EBITDA at 669 crores, which represents a growth of over 40%. The biosimilars business sustained EBITDA margin expansion for the second consecutive quarter, with Q2 FY26 margins at 25%, up approximately 400 basis points, representing improvement in operating leverage as we continue to realize the benefits of economies of scale. R&D investments for the quarter stood at 7% of revenues, reaffirming our ongoing commitment to innovation and pipeline advancement. And I would also like to say that for the second consecutive quarter, profit before tax exceeded 100 crores. Now, coming to business highlights, Q2 FY26 marks our seventh quarter as a fully integrated global biosimilars organization. And I can firmly say that we are well into the accelerate phase of our journey with multiple product approvals and launches over the last several months. We also have an adaptive commercial engine across geographies and strong product pipeline to drive sustainable and profitable growth. In Q4 of FY25, we had guided to launch 5 biosimilar products over the next 12 to 18 months, and I'm delighted to report that we have delivered on this commitment with 4 successful launches, which includes biosimilar ustekinumab, aspart, bevacizumab, and aflibercept across geographies, and expect an imminent launch of biosimilar denosumab. Now, coming to region-wise updates, in North America, we have, in the US especially, we have entered into a pioneering partnership with the government of California through Civica Inc., a not-for-profit organization, to initiate the supply of affordable insulin glargine under the CalRx initiative, which is the first of its kind in the US. We anticipate this model to scale to other states. We also broadened our insulin portfolio with the successful launch of the first and only interchangeable biosimilar aspart, with the large integrated delivery network, further strengthening our position in providing affordable, high-quality insulins to patients in the US. This quarter, we also achieved a key milestone with US FDA's approval of biosimilar denosumab and entered into a license agreement with Amgen, which enables us to commercialize this product in the US. Our oncology franchise continues to deliver a strong performance in both trastuzumab and pegfilgrastim under the brand names Ogivri and Fulphila, and hold more than one-fourth of their respective market shares. We further strengthened our oncology portfolio with the launch of biosimilar bevacizumab. When it comes to Yesintek, our ustekinumab, it gained strong commercial traction with a market-leading position in the US, securing broad coverage across major channels, supported by ongoing contract wins and exclusive formulary placements. In Canada, our Yesafili, or biosimilar aflibercept, secured public funding on the drug benefit formulary for Ontario, the country's most populous province. Since launching in Canada, Yesafili has had strong market adoption and has been designated in a preferred position in 3 provinces. Moving to Europe, our portfolio maintained stable market shares across products, with an uptick in both Ogivri and Abevmy market shares, strengthening our leadership in oncology biosimilars on the back of successful tender wins. We continue to advance our immunology franchise, launching biosimilar ustekinumab across 7 markets this quarter, marking a strong start to commercialization and setting the stage for accelerated growth with additional launches planned in the second half. Emerging market business delivered a strong performance. We continue to deepen our presence and expand patient reach, achieving 9 new approvals and 8 product launches across key markets in AFMET, LATAM, and APAC. Now, moving to the generics business, revenues delivered this quarter were at 774 crores, which is a reported 24% year-on-year increase, and sequentially, revenues have grown 11%. R&D investments stood at 71 crores or 9% of segment revenue, with continued progress across our GLP-1 and injectables portfolio. EBITDA stood at 43 crores, which is a vast improvement over last year and the previous quarter, driven by higher revenues. The generics business performance in the second quarter was driven by robust traction from the recently launched generic formulations like liraglutide, dasatinib, sacubitril, valsartan across key markets, along with increased sales from the base business both in generic formulations and APIs. As a part of our growth strategy, Biocon commenced with global filings of generic Ozempic across markets, including in Canada and Brazil. A key highlight this quarter was the inauguration of Biocon's first US manufacturing facility for oral solid dosage formulations in Cranbury, New Jersey. This facility, with an annual production capacity of 2 billion tablets, has been set up with an investment of over $30 million. We believe this will significantly expand our capacity to support the vertically integrated portfolio for patients in the North America region. Now, moving to our CRDMO business, Syngene's performance was in line with plan. Revenues were at 911 crores. Reported EBITDA of 215 crores was with a margin of 23%. Performance in this quarter have been in line with expectations, and this half have also met expectations. It is reflective of the strong underlying revenue growth driven by research services, which has compensated for the impact of anticipated inventory correction in biologics manufacturing. Strategically, Syngene continues to strengthen capabilities and expand its global footprint. The company secured its first global phase 3 clinical trial from a US-based biotech company, and this trial will recruit patients across clinical sites in India and the US, which reflects Syngene's growing capabilities in the global clinical trials market. I must also mention that the clinical trials footprint also expanded to Australia, New Zealand, UK, Sri Lanka, and Eastern Europe, strengthening the global trial execution capabilities at Syngene through both strategic partnerships and well-established CROs in these regions. Syngene is also building a GMP bioconjugation suite at its Bengaluru biologics facility, which will enable end-to-end manufacturing of antibody drug conjugates, positioning us among a select group of CRDMOs offering comprehensive ADC services. So, in conclusion, I would like to emphasize the strong and sustained momentum across our businesses, especially biosimilars. With the structured debt settlement through QIP, our balance sheet is stronger, and we expect a continued improvement in profitability in the quarters ahead. Our expanding biosimilar portfolio is certainly very differentiated, focused on high-value, high-growth therapy areas like diabetes, oncology, and immunology. Our integrated go-to-market engine enables expanded patient access and affordability through varied channels, reaching over 120 countries worldwide. The generics business also expects a good performance in the second half of the fiscal. And on the back of new product launches, we are excited and confident that we will see better growth in the second half. Our CRDMO business, Syngene, with its diversified service offerings and integrated presence across the value chain, is well positioned to capitalize on emerging opportunities and drive medium to long-term growth. Syngene is maintaining its annual guidance for FY26. With a solid foundation and a clear strategic roadmap, all our businesses are well poised to build on their momentum to deliver sustainable long-term value for all our stakeholders. Thank you.